Hi guys, my name's Colin and this is Colin Talks Crypto. I wanted to share with you a chart that I found interesting. And this is actually, credit goes fully to Benjamin Cohen of Into the Cryptoverse for this chart. And I'll go over that in a second. But what I think it's going to show us and what it tells me when I overlay it with the S&P 500 is that it does seem like another data point, yet another data point pointing to that we have not bottomed out yet in the economy, in the stock market. A lot of people think that back in August of 2022, right where I'm pointing here, this is the S&P 500, bottomed there, and that was the crash. They think that this drop from here to here was the crash. And I maintain to this day that that was not the crash for a number of reasons. And this is another reason. Another big reason, just as a by the way, that I think this is not the bottom, and it's very clear to me that it's not the bottom. And I could be wrong, but I would give it like a 90% chance this is not the bottom, is that unemployment never took off. And in every great crash, you have unemployment skyrocketing. And actually what we have right now is we have unemployment today starting to go vertical. That's not even what this video is about, but I just wanted to mention that as an aside because that's one of the bigger reasons why I am confident we have not seen the bottom of a crash in terms of like the last few years. This was a correction. This was not a crash back in 2022. Okay, so let's look at Ben's chart. Now he says this is an interesting way to look at the S&P 500. And he created a trading view formula, and the formula is right here. By the way, you can take this and copy and paste it into TradingView, and it will reproduce this chart, which is what I did, and I'll show you that next, as overlaid with the S&P 500. And I'll define this for you briefly. So the formula here is the S&P 500, SPX, divided by the unemployment rate, divided by the unemployment rate times United States inflation rate year over year times United States interest rate. And I'll be honest, I'm not going to be able to get inside Ben's head and explain exactly why he wrote this formula exactly the way he did. That's something you'd have to ask him. But what I do know is that when you create a chart and derive things from it that may coincide with certain market phenomena. And that's exactly what he's done here. And he says, I mean, he's done the same thing here. He says, hey, it sort of looks like it may be a way to identify bubbles. And the chart is very clear. I mean, there's clearly bubble here, bubble, bubble. Here's a bubble, another one here. This was the .com area. This was the housing market area. And then here was COVID, right here, this steep drop. And then here's where we are today, this massive, massive climb like we've never seen in the past 50 years. So clearly, this chart is indicating there are bubbles. Now, when I saw this chart, it struck me as interesting. And I immediately, like probably many of you, wanted to know, well, how does this time with the stock market? Like, what's the timing on this? Because that's important to know. That's like the missing piece of the puzzle. Like, what does this mean to us? Like, yeah, it's nice that we see a bunch of bubbles, but how is this going to help us? So maybe I thought if I overlay the S&P 500 on top of this chart, then we could see a pattern and go, hey, this is where we are, and this is where it looks like we're heading, and this is how much time it looks like we have. That's what I wanted to gain from this. So this chart's awesome, but it doesn't really mean a whole lot if you don't correlate it with another chart. And that's what this chart is right here. So the bottom half of this image here, this line, is the line you just saw that Ben created. It's that formula. And on top is the S&P 500. And what I've done is I've drawn vertical white lines between points of interest, which are basically anytime there was a market top or a market bottom in the stock market. And I wanted to see how did those correlate to the chart that he was showing us, to that formula. And it's pretty clear, actually, what it's showing us. you'll note that every time, we'll call this chart B, the formula chart. Every time that chart B peaks out, it correlates with a topping of the market, or I guess a subtopping of the market. This was an anomaly right here. So you could say this one did not fit the pattern. But like here, this is a top of the market for the next like 5 to 7 years. Actually, for the next 10 years, really. This right here was the top of the market, and it correlated with this peak of chart B. And then here's a peak. There's two lines here, if you look closely. The first line is this little peak, and it correlates to right before the COVID crash. We'll get to the bottoms next, the market bottoms. This right here is a top right before that correction that I referred to. And this, interestingly, does not correlate to a peak on this chart B. And this is where it starts to go astray, and it doesn't match. And my conclusion is that that's most likely because we're not at the top. For example, if we were at the top right now, this chart would be topping out, but it's not. It's declined all the way from August of 2022, where this local bottom was. So you'll also note that instead of looking at the market tops, let's look at the market bottoms, like the .com crash bottom, the housing market crash bottom. They correlate to basically chart B down here going back to 0 here and here. And even with the COVID crash, if you zoom in here, you'll see that it drops back down to 0 real fast. And that coincides with this pandemic crash. And you'd think that this drop right here, being fairly substantial, would correlate with a drop of some degree, but it's not. It's actually a peak on chart B. It's an inverted result. And so my conclusion is, my takeaway is that we have not seen the market bottom yet during the last few years here, because the chart on the bottom never went back to 0. If this was the bottom right here, then per this chart B and this formula, we would have seen this drop back down to close to 0, this yellow line at the bottom. And not only did we not see that, it actually went vertical upward. And this is not typical for this chart. It's not typical for this chart's history with being overlaid on top of the S&P 500. And so this leads me to believe that with the backdrop of all my other knowledge about the economy and the stock market and the historical patterns that tend to unfold and the timings, this leads me to believe that the greater crash has yet to occur. It's still coming. And so I think what we're going to see is a continued rally, and I don't know how long. That's always everyone's question. Trust me, if anyone knew the answer to that, they'd be billionaires, trillionaires. They'd foresee the entire market. They'd have all the answers. No one has all the answers. But we're trying to just extrapolate this. So what I think is going to happen is I think the market is going to continue to rally. And then it's going to crash at some point. At this point, I would not be surprised if it's on Trump's watch. Like he wins the election and then things start to go south because maybe he's going to try to get rid of a lot of members of the government that he feels are destructive. And I have a feeling they're not going to go down without a fight. And that's where I think that, and this is getting a little political, but this is how I could see it go down. And then the market's already kind of unstable because we've had a couple of years of an inverted yield curve. The most inverted the yield curve has been for a long time, like 40 plus years. So the market's already unstable. And even though the stock market's climbing, people's living expenses are going way out the roof. And the disparity between income and cost of living is greater and greater and greater. And so we are already entering recessionary livelihood for the average person. It's just not yet reflected in the stock market, which can be and usually is delayed. It's usually a delayed factor by 1 to 2 years, like longer than someone would usually expect. But we're now entering the territory where we're in the zone where it could really happen at any time here, and it's getting closer. So as I said, like while I don't necessarily feel that it will happen next week or maybe not even next month, I mean, anything's possible, right? It could. I think it's more likely that in the coming months, let's give it 2 to 6 months from now, that's where we should be looking for a market top. And this is just my current hunch based on the data I'm looking at. You know, as the ever evolving scene of market phenomenon unfolds, my opinion takes in the new data and I just try to guesstimate where we are in the grand scheme of things. So I do think that this chart B down here is going to bottom out again, and that will coincide with the bottom or near the bottom of the actual crash, which we have not yet seen. Okay, guys, so I just wanted to share this. Props goes to Benjamin Cohen for sharing this chart and this formula. I've never seen this before. Clearly, this is a very unique formula that he came up with. He likes to do this kind of thing. If you're not following him, I recommend you do. He's one of the few guys that, in my opinion, gets a lot of controversial calls right about the markets. And he gets calls wrong too, but he definitely thinks for himself and does not follow the herd. He just goes by what he sees and he holds to it. And I really respect that. Hope you're all having a great day. Talk to you again soon.